Go ahead and wait for that. Okay, you have at this point, if you look on the learning management system, um, Canvas, e-learning, whatever we're calling that, okay, you'll see that we left off here for what we're calling chapter 13 here. It's officially chapter 14 in the textbook, but I'm labeled as chapter 13 just so I don't have to revise the syllabus and stuff for different things, okay? But we stopped off pretty much here, okay? Okay, what happens when we have intermediary transactions? What are we talking about here? Well, we've talked about the not-for-profits receiving contributions, right? Okay, and it could be that a not-for-profit receives a contribution with the intent that that contribution will be passed on to another not-for-profit organization. Okay, classic example is the organization that you may have heard of called United Way. So what will happen? You start working for one of the firms. I'm not going to mention the firm because then I have to mention all four of them. But let's say you start working for one of the firms, and they'll have a campaign in which they will encourage you to do a payroll deduction that will then go to help a not-for-profit. And often they organize that through United Way. So United Way will have you go on their website, and you will select what not-for-profit you would like United Way to pass your contribution onto, your payroll deduction onto. Not-for-profits, like say our little Save the Canines example, like to get associated with an organization like United Way because they get a much broader audience that they can then advertise to provide contributions, right? Okay. Now, when you give that money to United Way and you direct them to give that money to, say, Save the Canines or whatever not-for-profit you choose, you have not granted United Way, keyword, you have not granted them, key phrase here, you have not granted them variance power. You have not granted them variance power because you have directed to them who they are to give that contribution to. Okay? If that's the case and you have not granted United Way variance power, then they will have to debit, probably cash is the asset that's given most of the time, and they can't credit contribution. It's not going to be reported like a revenue on the statement of activities. They're going to have to report a liability, something called a refundable advance or something like that, because that money is not theirs. That money is to be passed on to another not-for-profit. So to United Way, when you don't grant them variance power, that is considered a liability. To the recipient, say Save the Canines or whatever not-for-profit you've checked off that you want your contribution to go to, they will be the one that will debit a receivable. Hey, we're going to get some money pretty soon, and they credit what? Contribution, because that's money that's coming to them. You say, well, how would they know? United Way will probably inform them, hey, a contribution has been made in your behalf and that money is going to be coming. And then, of course, later on when they get the money, they'll debit the cash, they'll credit the receivable. Question? Okay. Now, there could be a situation, okay, in which you don't grant an organization like United Way variance power. If you don't grant them variance power, you're saying to them, hey, you're affiliated with various not-for-profits. You decide which not-for-profit should receive my contribution. If that's the case, now you have granted, say, United Way variance power, and instead of crediting a liability, they will credit contribution. And potential beneficiaries do nothing. They just sit there and wait for what? The hope that United Way will direct that money their way. Okay, so in a situation where no variance power has been granted, or excuse me, variance power has been granted to the recipient, say United Way, then what? Then they go ahead and treat that as a contribution. Okay, now the other exception, there's two. The other exception is if the intermediary, the entity that gets the contribution, is a captive of the beneficiary. What's that mean? Well, now we're talking about probably a university which sets up a foundation. You give the money to the foundation, but the foundation is there to what? To serve the university. And if that's the case, then what? Then the foundation knows that it's going to give that money to the what? To the university. They can go ahead and recognize that as a contribution as opposed to a liability. Okay? Okay, so let's just go ahead and take a look at a couple of this little example here. And we have a without variance power contribution being made. Okay, to a recipient, say United Way, say a foundation, right? If that's the case, then there will be a debit to asset, a credit to the refundable advance, which is a liability, right? Because no variance power has been granted. Now, let's see what the recipient will do in that case. And I tell you, see item B on the next page. So when you go to item B on the next page now, general rule, the beneficiary, when it's a without variance power situation, they debit the receivable, they credit the contribution, because they know that you have not granted the recipient variance money, variance power. That money is coming to them. That's without variance power. Okay. Now, if it is a with variance power grant, then what? Well, the recipient will debit asset, credit contribution, follow this little arrow down. The beneficiary does what? Beneficiary does nothing until the what? Recipient has decided that they're going to give that money down to that particular recipient, right? Because you granted them variance power, they get to decide who to give that money to. Question? Okay. Okay, good. Let's talk about investments. If you downloaded these slides earlier, you may see some intervening slides there. I made a little change prior to class, so if you see some other slides there, just go past those and get to this one, investments. Okay. Now what happens? When you account for investments in a for-profit entity, you have what? 3 potential categories for your investments. Those that are trading securities, those that are available for sale, and those that are held to maturity. Okay? If you have what? If you have a trading security, you mark that security to market every period, and even if you haven't sold that security yet, any unrealized holding gains and losses go directly to net income, don't they? Hello? Intermediate 1? That first chapter or so? Intermediate 1? Chapter 12? Huh? Or it's the last chapter, right? Chapter 12. Maybe that's what it is. Or is it Intermediate 2, the first chapter? I forget. But somewhere in there, you deal with, in that sequence, you deal with how to account for investments, right? If it's a trading security, market to market. Trading means you're actively trading that almost on a daily basis. Okay, you mark that security to market. Unrealized holding gains and losses go straight to net income. If it is a what? If it's a held to maturity security, you don't mark it to market, and you're going to do what? Any unrealized holding gains and losses, there won't be any, right? You're going to just carry that at amortized cost. Okay. If it is what? If it is neither a trading security nor a held to maturity security, then it is considered available for sale. And if it's available for sale, you go ahead and you mark it to market on the balance sheet, but any unrealized holding gains and losses go directly to other comprehensive income. They bypass the income statement and go straight to that section of stockholders' equity called other comprehensive income. Remember all that? Okay, good. Forget it all for not-for-profits. Not-for-profits do what? They mark everything to market, and unrealized holding gains and losses go straight to the statement of activity. In other words, they treat everything as though it were a trading security, right? See what happens when you don't have a real good lobby with FASB? Not-for-profits don't have nearly the lobby that what? For-profit entities do, and so they don't get all this consideration. Well, if you're going to hold it to maturity, they say everything is treated as what? As a trading security. Market to market on the balance sheet, unrealized holding gains and losses. There is no such thing as other comprehensive income. It goes straight to what? Straight to the statement of activities as a gain or loss. Question? Okay. And I probably should have changed the slide sooner. There's the rule right there, that stuff in the middle, that middle paragraph. Mark everything to market. Unrealized held in gains and losses go straight to the statement of activity. You're treating everything as though it's a trading security, right? Statement of activity is the name of our income statement for not-for-profit. Okay. Question? Okay. Other accounting issues, basically split interest agreements. What happens here? Let's say I'm real old. You're like, what do you mean, let's say? I mean, real old, okay? I'm like in my 80s, let's say. And I don't like my kids. I've had it with my kids. I'm not leaving you guys any money. So I've got this money. And I say, what am I going to do with it? I say, I know. I'm going to give my money to Save the Canines. And I'm going to ask Save the Canines to take care of me for the rest of my life until I die. And then they can have whatever's left over. Because I don't like my kids. Okay? In that situation, Save the Canines now has a split interest agreement. And that they're doing what? They've got some money, but that money is not going to just benefit Save the Canines. It's also going to benefit this old geezer, this old guy this nice guy until he finally dies, right? Because they have to sort of take care of him during that time. And when I say take care of him, I don't mean they're going to put him in the kennels with the dogs. I mean, they're going to take care of him by providing him some money each month, whatever, out of the money that he's given them. And then anything that's left over can be used for, Save the Canines. Okay, so what's going to happen? When we receive a contribution in that manner, we're going to have to report it as a split interest agreement. You can see different examples of split interest agreements. Charitable remainder trust. This one down here is sort of what I'm describing to you. Whatever's left, okay, can be used for Save the Canines. So you look, and when we have a situation like that, we will debit assets held in trust, usually cash. We will credit a liability to the beneficiary. And the way we're going to have to figure out that liability to the beneficiary, we're going to have to get an actuary in here, and an actuary is going to have to look and say, well, I think this guy's going to live another 10 years, and if you're giving him $20,000 a year, the present value of that is X, and the difference between whatever was contributed, the cash, and whatever we determine that liability is based on an actuarial analysis of how long this nice guy has left. The difference will then be considered a contribution, and it's considered a contribution with donor restriction because we have to wait for the guy to die. That's a time constraint, right? Anytime we have a time constraint, we consider that a with donor restriction, right? Anytime they tell us we have to wait for money, if we have to wait for money anytime, I don't care what it is, we're waiting for somebody to die, or we're waiting for a year to go by before they give us the money, whatever, that is considered a with donor restriction. Because the donor has pushed that contribution away from our ability to use it as we see fit, now not because of some specific purpose, but because time has to pass, right? Okay, now you look at this particular question, and it's kind of hard to read, guys. I understand that, okay? But this guy contributed $200,000 cash. Let me just tell you the story here rather than try to read it to you. The guy contributed $200,000 cash. He doesn't like his kids, so he gives this $200,000. Instead of giving it to his kids, he gives it to this not-for-profit. The not-for-profit debits cash. They have to have an actuary who comes in and says, looks like this guy's going to live another 5 years. You're going to pay him whatever it is, $20,000 a month. So the present value of that is $84,250, whatever, right? Now, sometimes people will say, well, wait a minute. $20,000 for 5 years, that's $100,000. We have to use the present value, don't we? So it's not going to be $100,000. It's going to be some amount less than $100,000. Okay, so it's $84,250 in this example. The rest is a contribution with donor restrictions, right? Because we have to wait till the dude dies to get our hands on the remainder and start spending it how we see fit. Okay. Question? Everybody sign in? Thank you, sir. Everybody sign in? Can you hand that back, sir? Thank you. Question? Okay, good. Other accounting issues still. Talking about split interest agreements here. Assets and liabilities that are held under split interest agreements need to be shown on the statement of financial position or balance sheet separately. We literally will call them out as what? Cash held under split interest agreement, cash held under charitable remainder trust, whatever. So we don't commingle our unrestricted cash with cash that has this trust situations associated with it. Okay, when we receive that liability, the present value of the amount will have to be called out as a liability that's held under a split interest agreement. Okay, the contributions when they come in under split interest agreement, that 200,000 will, I mean not the 200,000, but the 115,000, whatever was left, it'll show as a contribution under split interest agreement, and it'll be under the what? With donor imposed restriction column. Until what? Until the guy dies, and then we can do the reclassification adjustment, take it out of the with donor and put it into the without donor restriction. Okay. Question? Got to use fair present value for these. Present value. Other accounting issues, okay, donated collection items. Do you remember the story of the pitchforks in Hayward? See, don't remember my dumb stories and it ends up costing you. You got to remember the dumb stories. If I tell a dumb story, you should be paying all kinds of attention to that if I tell you a dumb story, right? Because not-for-profits follow the same rules that we saw for the state and local governments, right? So let's say, I'll tell you another dumb story, somebody gives Save the Canines, our little made-believe not-for-profit, right? It's a make-believe not-for-profit, right? There's no real Save the Canines, it's made up, okay? I have to say that because I had a student that came up to me one time and said, where is Save the Canines? Is it in Hayward? No, okay, there's no such thing as Save the Canines. It's made up. Although there are, animal rescue not-for-profits that do that kind of work. No-kill shelters. They try to place animals with the home. In fact, some of those are so restrictive that, like, if they give you the dog and then you decide later on that you don't want the dog and you try to give it to this person, they'll come and take the dog from you because it did not go, and they find out about it, because it did not go through their process, right? So they have a very, stilted, whatever, structured process, whatever, and placing the animals with the appropriate home. And if they find out they'll come and rip it out of your kid's hands. Give us that dog back. You're entitled to that dog, okay? So they do have these organizations, okay? So let's say that somebody gives our made-up one, Save the Canines, they give them the original painting of the dogs playing poker. Have you ever seen this thing? Okay, it's like this painting where these dogs are cheating, playing poker and stuff. It's like this famous painting. They give us the original. This thing is worth millions. Should Save the Canines put that on their financial statements? And just like Gatsby did for Hayward with the pitchforks, they are encouraged to put that on their financial statements, but they don't have to as long as they meet all of these criteria. So the exhibition is what? It's held for public exhibition. The collection is cared for, preserved, and the not-for-profit is subject to the policy that if it sells one of those collection items, it'll use the proceeds to do what? Acquire other collection items. If they meet all three of those criteria, then the not-for-profit does not have to put that donation of that collection item on their financial reports. Same exact thing we said for state and local governments. Three criteria, got to meet all three of them. Question? Okay, good. That is the end of chapter. It's officially chapter 14 in the book, but we're counting it as chapter 13. Okay, good. Let's look at chapter 15 slides. Guys, don't drift off. Because if you sleep through chapter, and I don't know why it says chapter 12. I have no idea why I said chapter 12, other than that I'm an idiot. Chapter 15. Okay, this is chapter 15. It's not chapter 12. Okay, chapter 15. If you blink, you'll miss these. We got 2 slides. Okay, what we're going to talk about is something that is unique to colleges and universities. And what we need to consider here is what happens if we provide discounts, allowances on tuition. How do we account for that? Well, notice we go ahead and we take the what? Tuition and fees, and we are going to credit that gross. Then we do what? We debit the receivable net of any discounts on tuition, any scholarships, that sort of thing. Okay? And we will debit discount and allowances. This discount and allowances is just like the discount on sales that you could have. You book the sales gross and then you debit the discount, sales discounts. Okay, and we're going to go ahead and debit the receivable net. So when we show on a college's statement of activities, let me try to make that a little bigger. So, great. My mouse's battery is out, so I'm having to use the mouse on the computer, which is horrible. There it goes. Okay. When we look at the statement of activities for the college now, notice in our without donor restriction, we're calling this unrestricted here, but without donor restriction column, there's our tuition and fees. Remember, tuition and fees are always considered unrestricted without donor restriction. There's our tuition and fees, and then we do what? We subtract that debit, which was the tuition discounts, scholarships and tuition discounts, and then we report it net, just like a sales discount, right? Is that just like a sales discount? If you're waiting for deeper meaning, stop. That's all I want you to know about colleges and universities, because everything else, guys, is the same. As we what? As we meet a donor's restriction, we come out of the with donor restriction and into the without, don't we? All expenses are what? All expenses are automatically considered without donor restriction. Okay, so the function of the statement of activities that we talked about last time is exactly what we talked about last time generically for all not-for-profits. We're doing that for the colleges, right? But because colleges have this unique aspect that they provide scholarships, tuition discounts, and whatnot, I wanted you to understand how we would handle that. That's it. Okay, that's the only thing that's unique here for the colleges. Question? Okay, good. That's the end of chapter 15. Chapter 16. Chapter 16 now is going to be, I guess I can close this, healthcare organizations, hospitals. Question? Are you recording these chapters? I hope so, because this is some of my best work. It would be such a shame if this was lost. No, but I'm not getting the audio read. You had to ask. I don't know why it's not showing me that the audio is coming through. It was coming through a minute ago, so. So just in